Well, hello, everyone. Again, I'm Andy Hoffman with Wilson Sonsini. And rather than introduce these esteemed gentlemen to my right, I think I'll just kick it off by asking them to go one by one and introduce themselves, maybe just a brief statement about where they work, what their role is, and given the topic of this presentation, maybe a word or two on where the revenues were when they started and when they finished in a couple of cases. So, Zack, why don't you lead us off?
So I'm Zack Urlocker. Most recently I was COO at a company called Duo Security. I think it was about 17 people when I joined. They were doing about 6 million. Grew that to about just over 100 million in revenue and $1 billion valuation. And prior to that, I did something similar at ZENDESK. Grew that from 7 million to beyond 100, and MySQL before that. So I guess I've had $4 billion exits. And I work with a lot of early stage startups to try to help founders and entrepreneurs scale their business.
My name is Randy Gottfried. I am audit committee chair at DataStax. Most recently, I was CFO of AppDynamics, which was sold to Cisco last year. At AppDynamics, I joined at about $80 million of revenue, and when I left, in the year I left, we were on track to do close to 400. Prior to that, I was with RIVERBED Technology in San Francisco. I joined pre-revenue and left at just over $1 billion of sales. I was CFO and COO of RIVERBED. And then prior to that, a company called Ink2Me, which close to zero. It was a few $1 million of revenue when I joined, and it was about 300 plus or minus $1 million, $100 million of revenue when I left there.
I'm Tyler, so I'm the CFO at Zuora. I've been there for 8 years now, or coming up in 8 years in September. I think we had about 4 million when I joined the first year in GAAP revenue, and we did a little over 160 million last year. Prior, I've had roles at Siebel, ran their on-demand unit there for finance, as controller of network appliance, and then it's my 4th private company. So I was at Poet Software, which took public in the late 90s, Decrew, which we sold to NetApp. And then my last one, I was a CFO of OboPay, which is a mobile payments company.
Great. Well, thank you, guys. And as you can see, there's a lot of experience up here on stage. So jumping in on the finance piece, so maybe, Randy, you could lead us off. What do you think are the most important things for finance to manage, track, and improve as the company scales?
Sure. It's going to depend on where you are in the life cycle. And there's going to be a couple different answers I give. Just to run the company and do your job as CFO, cash and burn rate, understanding what that is. And that, for many companies, that's going to be making sure you have a good handle on headcount. For some SaaS companies, it's also going to be things like your Amazon's usage and things like that. Then there are things just to run the business. I think a good CFO is beyond just the cash. It's going to be understanding lots of different things, and it's going to make sure you have an infrastructure to capture data that you can find out as you're evolving what are the most important pieces. So making sure you got infrastructure that captures lots of different pieces of data such that you can make use out of that later on down the road.
Great, thank you. And picking up on that, Tyler, what do you think are the key finance-related factors that can be roadblocks to successfully scaling?
What could be a roadblock? I think, I don't know, the first one that comes to mind is alignment. Similar to what Randy just said, take it even a step further. I think the CFO primary job is to own the business model within a company. And then as, specifically recurring revenue businesses, which I've been involved in, CFO is oftentimes the only one who has a purview into what's happening in all different functions, but then making sure that you can bring all that data back and inject it into the function so that you drive alignment on what the business model is across all of the executive team. And therefore they can align it into their functions. When that doesn't happen, then that becomes the biggest roadblock.
Thank you. And I'm sure Zack is shocked to hear he's next on the hot seat. But switching over to the same questions from an operations perspective, what do you think the important things are to track, and what are the key roadblocks?
For me, I was responsible for sales, marketing, product, those sort of functions. And so I work very closely with the CFO and the companies I've worked with, but I'm all about how do we increase our ARR. And if you're growing at a very rapid rate, if you're growing in excess of 100% year over year, then that means it's a new company every year. And so the key thing is to figure out, how do I make this company a little bit more efficient every year as I scale? Because when you're growing at that rate, small problems left untended become really big operational problems later on. And so you see this sometimes in companies that are not growing so quickly, where, as an example, they'll throw bodies at problems. And they don't develop the discipline to look ahead and say, hey, if we keep solving this downstream with bodies, like, this is going to get really expensive and affect our profitability. So I'm always thinking about, how do we look for efficiency? And that can be measured in, you know, CAC ratios, similar things. But I'm also looking at, what's the churn rate? How, you know, are we able to drive down our customer acquisition costs? Marketing as a percentage of spend, you know, should go down over time. Deal size should go up over time. And there's a lot of different levers you can work with, but you have to pick a small number of these things and try to get the whole company attuned to 3 or 4 metrics. It might be different in any business, but if you end up having, you know, sometimes I'm on the board and you'll see this deck of like 90 slides. As a board member, like, I sure don't really want to look at 90 slides of metrics, and I'm sure none of the management team is looking at it. So I try to distill it down to as small number of metrics as possible.
Great, thank you. And then maybe I'll ask one of the finance guys about their views on the operations role. So Randy, switching back to you, what do you think the biggest upside is to having a CFO also serve as COO?
I think a good CFO really helps execute on the vision of the company. I get calls periodically from CEOs who say that their CFO is not strategic enough. And that's usually code for he or she as a CFO is good at saying no, not really think about how to build a business. Your job as CFO is to help build a business. That's the #1 priority of that person. And so it's really critical that you're looking not just where to save money, but where should you be spending more. And that's, I think, a good CFO really has their nose really across the business and how to make sure it runs better, and not just making sure they don't do something bad.
So Zach, picking up on that, what do you think are, again, some of the upsides, some of the drawbacks? How much of that is particular to a given company and their culture?
Well, I think a lot of it depends on, maybe not the culture, but it depends on the composition of the executive team. And so, like, probably the person I worked most closely with at Duo was the CFO. And he and I kind of built the business strategy in a lot of areas. And I've never been a CFO. I've never played one on TV. I have an appreciation for the metrics, but not in the same way that a CFO does. So I think in some companies, if you have somebody with the right skills, clearly, both these guys, where they have an operational perspective, but it depends. You can be in an executive team where the CFO has that, or they might not have it. So I think you just have to look at what are, across the executive team, what is it that the skills that you need around the table? Who will supply those? And usually what happens is you look around and you say, okay, well, we need to upgrade over here, we need to upgrade over here, we need to upgrade over here, particularly as you're growing. And then you'll figure out, okay, do we have enough of the skills to run the business together? And if it was in one person, that's great. But it's sort of like sometimes you'll have a title head of sales and marketing. It's like those are actually very distinct skills. There are some people who can do both those jobs. Most salespeople can't, most marketing people can't. So you just have to figure out, like, did you find that in the right candidate, or did you end up elevating somebody's title to the point where now they're pretty much going to fail because they've never done both sides of that equation? And I think probably for the people who have been CFOs and COOs, like you've witnessed an evolution in your own skills to the point where, yes, you could do that, and at an earlier stage, seeing other people who maybe might not have been able to do that, even though they were CFOs.
Thank you. So picking up on that, Tyler, how do you think the demands of a CFO and that role has changed over the last decade?
I think the CFO, if it's about bringing the business forward, which it is, and I think about how you engage with the rest of your executive team, then come back to alignment. How do you get everybody aligned around it? But then also, some of the stuff takes a long time, right? Some of the things that you need to put in place from a business model perspective can take years for it actually to unfold. And sometimes a CFO happens to be the best place to be that governance and function to be able to make sure that that keeps happening every single period over period over period, so that you get to see the fruits of that labor, 1-2 years down the line. What we do at Zuora, so sales ops, I built a function there. The orders group still reports up through me. Pricing still is a finance function, where oftentimes it's marketing or product or something like that. And it's not because it's not collaborative. It's just because the governance function of knowing that the business model success is contingent on a rapidity of things that are going to happen over and over and over again, that you actually get to see the fruits of that labor over time. That's sometimes the best place to put it, just to make sure it's going to stay true.
Thank you. So for the next one, I'll make this a jump ball rather than putting any one of you on the spot. But looking back at the process of scaling your businesses, what are the biggest regrets that you have had from sort of a finance and an operational metric? Don't all go at once.
I'll go first. It's pretty funny, actually. I think it's in the book that Teen talked about earlier, but we decided like 6 years ago we were going to run a subscription business model, and it's completely different because it's what we do. And we came up with a bunch of metrics, and we came into the board and said we're not going to do an annual budget. We're going to run this fluid thing, which is a subscription business model governed by a bunch of metrics and governed by a couple of key indicators. And we went in and presented that to the board. Didn't pre-sell it at all. Didn't really come in and get and iterate enough on it. And I think I came within about 5 minutes of being fired. I don't think, actually, I did come within about 5 minutes of being fired. It got to a point where Teen's like, okay, we're going to cut this meeting off, and we will come back to you guys. And so there's a lot of lessons learned in that. You're trying to do something different. You better do your homework. You better go out and get a lot of data, get a lot of benchmarks, and then better be willing to iterate and make sure you work on it. And part of that is pre-selling. And so that was a good learning moment. It was great.
I don't know that I have a regret, but I'll say something that I think has been instrumental to do, and sometimes you see it more in the cases where it's not done. Not in anyone's company here, I'm sure, but which is to scale a company at a very rapid rate from 1 to 100. As I said, it's a different company every year, and what that means is you have to continually upgrade your talent. Now, you can never hire enough great people to lead you there, and so you have to act from the outside. So you have to actually make sure that you're investing in developing your middle managers. And I actually think the key to scaling a company rapidly is to have really good managers. And oftentimes in early stage companies like sub 10 million, you go around and you say, okay, who's a manager? How did you become a manager? It's like, well, I was the tallest person in the room, so they made me manager. Or everybody else didn't want to be manager, so I became the manager. And what you have to really help managers understand is they're in the business of making decisions. And over time, hopefully they can make good decisions. And when a crisis happens, hopefully they're not deer in the headlights and they don't know what to do. And I remember one time at ZENDESK, and Mikkel is a fantastic founder and an excellent CEO, has done remarkable. But in the early days, I remember he said to me once, every morning I had this long line of people outside my office. Why are they always doing this to me? And it's because you don't force them to make decisions. So you really have to try to identify among your managers and give them that authority and responsibility to actually make decisions. And it's interesting because you'll see some managers who really thrive with this and others who are like, I thought I was just communication between what you guys want and what those guys don't want or something. It's like, no, that's email. We use email for that. So I think if you can really instill responsibility in your managers and figure and decide early, okay, some of these people will be the future VPs in the company. We have to get them actually making pretty important strategic decisions. And sometimes they're going to make decisions that are contrary to what you would make. And you have to shut up and let them do that. Now, there's some strategic decisions like, okay, we decide to go public or we decide to open source our stuff, where you say, okay, no, we're not going to make that decision at this level. But the more you can push decision-making down at an operational level, the faster the pace of the company. And, as long as over time they make more right decisions than wrong decisions, you build a strength in the organization that is fantastic. Because the opposite is really a bad situation to be in, where nobody wants to make decisions, or they're worried that, they think that the board will make all the decisions, or the CEO will make all the decisions, or whatever. And the people close to the problems, in my experience, are way better at making those decisions.
I agree with those comments that were just made. From a different perspective on this, from the CFO's desk, tying it to the finance and operations topic a little bit, you know, the regrets I've had, I've worked in different companies. Some have spent time to get it right from the beginning, and some I've sort of inherited a mess coming in later. And it's funny, there are a lot of people who are starting a company and growing a company who maybe they come from the development side or the sales side, and they understand the lead times and the investment required to get the development to work, product to work. They understand from a sales perspective and getting a field organization or a marketing machine to work, and they get the investments required there. Some of those same people then think, well, in the operations, we're going to then demonstrate our frugality by not do anything until the last possible minute, and then we're going to drop a more professional organization, a more professional approach sometime later. And I think what they realize in so many cases is that the operations side, not just finance, but a lot of our elements of operations, require that same sort of investment. Sometimes there are multi-year lead times to develop systems, to capture the right information, to staff the functions appropriately so that you can operate not just at a $1 million company, but $100 million or eventually $1 billion. So those long lead times really require you to invest more up front. And a lot of people don't appreciate that because it's not necessarily their area of expertise.
So thank you. And in that same vein, maybe we can get a word from each of you on your top advice on how finance and operations can work together and how you can make those transitions from $1 million to $100 million and then beyond. So why don't we start right here?
I think, first of all, having agreement, not just between finance and operations, but across the executive team about what the important metrics are. And again, this might vary in companies. You know, at ZENDESK, NPS was a very important, Net Promoter Score was super important to us. It measures the degree to which people love your product, and we want people to love our product. But, you know, there's also financial metrics and how much are we going to invest in different areas. And then we would agree on what our efficiency would be in enterprise sales, in, you know, inside sales, et cetera, so that we would have a framework for understanding, okay, when do we invest more in this particular function? You know, we have to see a certain ROI from our investment in salespeople or whatever to guide us, so it's not just this quarterly jump ball about how much budget there is. But, and you know, you're making it up a little bit, so we would have some parameters that in high growth stages where you might say, okay, we're going to revisit this mid-year, but it doesn't mean we're starting from scratch at mid-year. You know, it's like we still want to achieve our goals, but if we're way over or way under, we can have another conversation. But trying to instill discipline across all the functions, whether it's, you know, how many engineers are going to work on a product or how many leads are required, how much pipeline is required from marketing, getting agreement on those metrics between each of the groups that works together. So sales and marketing have to be in alignment on how much pipeline and what that's going to look like, and how much we're willing to pay for that. And then if we see an additional opportunity, sometimes this would be Paul, the CFO, saying, hey, we can spend a little more here if you want, as long as it performs in this way. And then we decide, do we want to do that or not?
I'll add something. I mean, I think there are a couple of things. One is make sure that, you know, the CEO is shepherding the right goals for the company, you know, the right amount of goals, the right goals that everybody need to coalesce around. That's a really critical thing to make sure people are working from the same playbook. And the second thing is a harder one, which is to staff those lead roles, lead executives in the company with good business people. It's very easy to sometimes find a role player who's good at what they do. In order to propel the company to that growth, you need people who can think not just about their area, but how it interfaces with everybody else. You need a head of sales who understands the finance side. You need a finance person who understands how hard it is to sell and to develop a product. You need developers to understand that you need to be able to show a return on this investment that you're making. And that's a much harder one, but it's so critical to be able to grow in the long term as you need people who can think outside of their own area, which allows them to then work together.
Yeah, we don't see a huge difference between finance and operations. We start with a business model concept, and we have a business model that's been the same for years now. We have a couple of different metrics that plug into the business model that we can tell whether we're doing a good job or not. And then we have an operating model, and it's different. And there's a cadence to that operating model that then is a score sheet that allows us functionally to determine whether we're actually going to go achieve the business model. Our operating model we call PADRE. It stands for Pipeline, Acquire, Deploy, Run, Expand, and then we have PPM at the end, which is Product, People, and Money. Finance might be the kind of the overseer of that operating model. My group is responsible for coming in every week, and we present at our executive staff for an hour each week on the operating model, the PADRE report. And we can do deep dives into every single element of PADRE, so it could be a pipeline deep dive or something like that. But they're all tied to each other, and they're all supposed to be relatively fluid, indicators of risk, indicators of opportunity areas, and that is what we view as a kind of the operational heartbeat of the company, but it feeds back into the business model, which is the financial heartbeat of the company. So they're all very tied together.
Thank you. So, Tyler, I'll be sticking with you, but drilling down a bit into considerations for an IPO. Obviously a hot topic of late around here. Maybe you could just give...
Seems to be the cool thing to do.
all the cool kids on stage at least are doing it. But no, if you could just talk about, what do you think it takes for a company to go public in this environment? And if you're able to work in a plug for others on this stage, that would be much appreciated.
Yep. Underwriters Council right here, which was great. It actually was a very, very smooth process. Went really, really well. But he prefers to work on the company side, is what I'm told. No, what it takes to go public, I don't know. You have all these companies that are going out right now. I think we're going to see a ton because there's companies been building up their businesses, depending on your business model. But I would say absolute predictability. And a vision for what's going to happen without, a high degree of risk. And that has a lot to do with, say, management that you've built in and your capability to, say, run a finance function with leadership, not, the CFO, but the people actually doing a ton of the work that have done it before and they've played that fiddle before, all the way through to your market, right, where that you know where it's going and you have the capacity to actually go execute against it. Part of it's around scale too, where it's just companies are waiting and they're getting bigger, but part of it's because the investors are demanding that, and they want to put their money to work with a company that actually has a little bit more meat to it because there's so much money out there that they have to. So I think there's a whole variety of things, right? I think this year you'll see smaller companies going out as well, but they might have huge opportunities, been growing at huge rates, but those companies they might actually have hiccups the following years too.
All right, well, picking up on that, Randy, if maybe you can speak to what private companies should be doing differently and start thinking about and preparing for if they think they do want to end up going public.
Yeah, there's probably a few things to pay attention to. One, again, the most important thing to go public is a big enough market and a defensible position and unique position going after that market. So whatever you can, the investments to make to get your product line filled out as appropriate. It's not going to be fully baked. You don't wait too long so that the market comes and passes, but you have to have a good position in a big market. And from an operational perspective, the investments you can make now are to operate with the position as if you were a public company. It ranges really across your operations, but certainly in the finance function, have a predictable business, manage as if you were a public company with that same sort of rigor. Think about all of the things like the accounting side, some of the things that are more sort of afterthoughts to private companies, you have to have in a position that operates with precision and speed such that you can operate in a public company environment.
And then, Zack, picking up on that, how do you think about your internal measures of performance? How much of that is developed internally? How much of that is sort of a peer analysis, looking at what competitors are doing, looking at how the market is viewing public competitors?
You can get some information looking at the public markets and comps to understand, okay, how much are my peer groups spending in different categories? But I don't think it's all that useful because those are typically public numbers or the year or two before you're going public. And so the closer you get to 100 million, okay, there's some usefulness there. But what I do instead is I try to look at each function in the company and say, how do we continue to get improving efficiency? And there's sometimes this tolerance of, well, you know, we don't have to be that efficient, or we'll see some deterioration in our cost of goods or deterioration in our marketing. You know, our marketing will get less efficient over time. And I just call BS on that. It's like, no, there's no reason it should get worse. It should get better. And, you know, lots of companies can go public. And, you know, you see some great IPOs, and then you see some other IPOs. If you want to be a great IPO, it means you have to have improving unit economics. Your deal sizes are going up and your costs are going down. So you just have to kind of be disciplined about that and look for patterns among your customers that enable you to be efficient. And you really have to be very sensitive to where the money is being spent and resist the urge that says, you know, you sometimes hear this from VCs, you know, just pour more gasoline on the fire. You know, marketing people can spend a lot of money if the goal is just to spend the money. But if your goal is to spend the money efficiently, you may not actually be able to spend as much as you would like, but that will enable you to get a higher degree of efficiency. And so those are the kind of metrics that I look for. And then you have to be pretty involved in each area to really have this self-examination and hold each group kind of accountable to that and say, look, as revenues double and go up, your budget doesn't double. So what shall we do to eke out more efficiency? And a lot of it is headcount. So as long as you're looking for ways to continue to automate things, make it better, and then find the patterns which have high ROI from a marketing perspective, do more of those. And the things that have lousy ROI, do less of those. And it sounds funny, but it's amazing how many companies don't really adhere to those things.
Well, thank you. So switching from that to the financial model, I can start with Tyler or Randy, whichever of you prefers this one, but how do you think about developing your model? And for those of you going public, how do you think about your internal model versus the one that you're going to be presenting to the street?
There's a difference?
I'm not aware of one.
No, the financial model is, again, for us, it goes back to the same concept of the business model. And we spent a lot of time in educating the investors on the way we think about our own business. This is the most important. You better understand your own business and then how it evolves. And then we told the investors to hold us accountable to the same things we hold ourselves accountable to. So Zack just said, hey, you better drive efficiency. So we have like two concepts. Growth efficiency index is a number that we run, which is like our take on a CAC ratio or magic number. It's effectively what do we get in return for the dollars that we inject into our sales and marketing engine. And then we have a concept called recurring profit margin, which is the delta between our subscription revenue and then what we say it costs us to run our business, which is COGS, G&A, and R&D. And so we want to have recurring profit margin expansion, which means that we grow subscription revenue faster than we grow COGS, G&A, and R&D. They're relatively simple at the highest level. You have a lot of detail underneath it, but they're calculable off of the income statement. And there's something that investors can repeatedly look at, and they can compare us to other companies, and they can hold us accountable to doing it more efficient. We then take that, we clearly drive it internally. We actually get compensated on these things internally, and we hold ourselves accountable to hit those efficiencies as well.
Thank you. All right, and then last but not least, I'll let you wrap it up, Randy. How do you handle the curveball? The IPO turns into a dual-track process, and what do you do differently?
Hypothetically speaking.
We're about to start a new session just on this.
And intentionally, I saved this right for the 11th hour.
The interesting thing, at AppDynamics, we were sold to Cisco, though we really didn't run a dual process. Cisco came in right before our pricing of our IPO. We were about 28 times oversubscribed with several days left in the process, and they made an offer that our board couldn't refuse. I think in general, it's always good to have options. And you want to have the best alternative to whatever you're going for. For an IPO, somebody comes in with a number, it has to be compellingly better. Likewise, if somebody comes in and you don't want to be in a situation where you have to sell. So make sure you understand your cash. So as a younger private company, you don't want to be, have a gun to your head that you're running out of cash and have to sell the company. If you're going public, you want to make sure your IPO is compelling enough so that you're not forced to sell to save some embarrassment. So it's always good to have options. Great. Well, we'll leave it on that note. Options are always an excellent thing to have. And
Thank you very much, gentlemen.
Awesome. Thanks, Andy.
Thank you.